All right, well, welcome everybody to the August 11th edition of Bull Sessions. My name is Mark Robertson. I'm founder and managing partner of Manifest Investing. I'm joined here by not just Ken Cavula, but certainly Ken Cavula. Kim Butcher's also in the room here with us, kind of around the cyber table, and we're also joined by Hugh McManus. And I think we're gonna kick into some fairly interesting areas of discussion today. You will note on the lower left that I borrowed Ken's sanctioned certified face mask from, I believe, our Christmas edition, or just after Christmas, I guess it would have been. And the bull is now wearing it, so he's ready to socially distance. Appreciate you doing that, Ken. Good afternoon.
Good afternoon, everybody. Glad to be here.
And then just to kind of warm up the crowd a little bit, I'm actually in northwestern Illinois, coming at it very remote. And we spent the weekend celebrating an 80th birthday for my mother-in-law, but I returned to my in-laws' residence to a whole bunch of downed trees and no electricity and no internet. And it's been kind of a scramble here this morning. And I've already been kicking around this notion of we're going to be talking about some interesting stuff, maybe a little bit on the frisky side of the investing world. And I think it's a good thing. Some of you already recognize this slide on the lower right, from perhaps corporate brainstorming sessions or whatever. But again, close your eyes and just think about, at some point in time, there was this room full of movie innovators and executives, and they're sitting around the conference room table, and somebody around the table said, I think we should make a movie about a tornado full of sharks. I mean, think about what that moment had to be like. I mean, for those of you who don't know, and you may be among the more fortunate amongst us here, I believe there's at least 5. Anybody know how many Sharknado episodes are out there? Movies, full-length movies.
I think it must be 5 or 6. I mean, I think they issue a new one every year, right? I haven't watched any of them.
I'll have to give my daughter a call. If my daughter wasn't working, I'd call her, and she'd not only know how many, but she'd be able to spin out a lot of facts about them for you, Mark. She watches them all religiously.
Well, the thing that got me interested was in, I think it's Sharknado 5, they had all these mega stars who wanted to come and make cameos, and they wanted to be in it. It is literally, for those of you sitting out there not believing we're even having this discussion, it's about tornadoes sucking up sharks and sharks flying around in a storm in the United States. It's just amazing. But again, I mean, how crazy was that idea? And we might touch on a few of those ourselves. Who knows? You never know. So let's go ahead and get underway. You guys all know this drill. No investment recommendation is intended. This is an educational demonstration. Not only that, this is kind of an experiment where we think we can come together and talk about a few things. It is for illustration and demonstration. We're basically taking and extending the philosophies and methods of the modern investment club movement and trying to share and learn from them. The views we express are ours, own. Please form your own views, do your own homework. We may own some of the stuff that we talk about here today, and keep that in mind. We do a monthly webcast. The 4 people here are regular participants in the monthly webcast known as the Roundtable. It's always the last Tuesday of every month. If you'd like to be added to a reminder list about that, you can send an email to mcavula1@comcast.net. If you have any follow-up questions or if you need anything, send me an email at markr@manifestinvesting.com. All right, just as a reminder, what we really want to do is just kick around some stuff. And I'll tell you, we talked last month about how crazy PE ratios can be. We're going to talk briefly about Adobe and how it looks like the paycheck. I guess Adobe is the new paychecks when it comes to PE ratios. So we'll talk about that. And then we will also talk about, we'll close with this notion of how might we look differently, almost in the form of Sharknadoes at some of the early stage companies. And we're just going to kick off the topic today. and dig into it much deeper. You know, how might we have seen Amazon or Google or any of those type of companies as a better opportunity earlier in their life cycle without violating any of our principles? And this list is just something that we're going to kick around from time to time as we do these Tuesday sessions. But today's first topic here today is going to be Jim Cramer's COVID-19 index. And one of the things that really kind of gets me juiced about these sessions is it's going to push us into areas which are just good for everybody involved. In this case, we're going to be adding 10 to 12 new companies to the manifest database because they're in Cramer's index, and it's going to push us to think about some of the companies that are in this index in different ways. But it's just an example of taking something, and Ken came up with this one a few weeks ago, and I had no exposure to it at that time. It's just an example of how I think what you'll see as we go through here in the next few minutes, an example how this type of thing can lead us to some very interesting areas. And then we'll obviously cover the other areas and areas like them and the rest of those bullet points. We will dedicate the last Tuesday of the month to completely your input, the mail and stuff that you send, and Manning's contribution last week, Len Douglas's that he's had here over the last couple of weeks. Those are examples that we really love to tackle that sort of thing. Let's go ahead and get underway. Ken, why don't you go ahead and describe this? I'm going to call it a phenomenon at this point. Go ahead.
Okay, well, first of all, the index is available if you go to cnbc.com/Cramer or COVID-19 index, or if you just use a search engine and use the words Cramer and COVID index, you'll get to a list of the companies. Mark's going to show them to you. It's obviously been doing pretty well since he put it together, and he basically put it together after the close down of the company. Now, he had been doing some thinking about it prior to that when COVID was first announced as a pandemic, but the actual list didn't come out until somewhere around the middle of March sometime. And what I like about it is that I've always thought that Jim Cramer invests kind of like we do. And there's a whole bunch of companies on this list that I own and that I think really have benefited from the economy's shutdown. I know that's a terrible thing for a company to have to admit, but there were companies that benefited from the shutdown in the economy. But then the index goes further and looks at some new kinds of technology, some companies that would definitely be in George Nicholson's non-traditional investing style, and part of that 30% of your portfolio where you can feel free to play around a little bit once you have some experience and once you have a little bit of free cash to deal with in your portfolios. But Mark, do you have the list? Could we go there and just take a look, let people kind of get a feel for what the names look like?
Yeah,
there they are.
I want to give you just an appetizer. Oh my gosh, guys, this index is up 60% year to date. The stock market's up 4%. So as you go down that list, or Ken, I mean, there's a number of early stage companies. There's a number of companies. I mean, Etsy is at the small company list for this year. I mean, from top to bottom, and then 100.
You're cutting in and out, Mark.
Okay, you go ahead and take it.
You're cutting in and out.
Go ahead, you take it.
Well, and I can tell you, Ken, that WIX, that's one of the new companies that was added to Pat Dorsey's portfolio. Dorsey Asset Management.
Well, I mean, there's some favorites of the community on here. We've been talking about Viva Systems, for example, for, I don't know, a year and a half, 2.5 years right now. NVIDIA has been a stock of interest for at least 2 years, maybe longer, on the index there. I've held Boston Beer in my portfolio for maybe 8 or 9 different years. It hasn't been a steady grower, but the general trend has been up, and more recently it's been up considerably. I like Shopify. I won a contest here in our local area, riding Shopify to the top of last year's Stock Pickers contest. And it definitely is a stock that I think that everybody should at least be aware of the concept behind companies like this. Livongo Health, we right now have 2 or 3 folks in our local contest riding it to the very top. I didn't know anything about Livongo Health, except that I've heard a lot of people compare it to the Doctors on Call kind of company, and that's exactly what they're dealing with. Well, you can see the uptick in return in the last 4 or 5 months on that company. And then we have the ones that are dealing with the vaccines. Moderna's on that list, dealing with creating the vaccine. The name I was trying to come up to compare Livongo with was Teladoc. And Teladoc's also on this list, about halfway down. Either one of them are really interesting for you to sit down and take a look at. But I'll wager that there's a half dozen or so names on this list, maybe more, that most of us know nothing about, and we would like to know a little bit more about. Now, there's also other stocks in the index that are much more traditional. He also has taken a serious look at stocks that tend to be slower growers or tend to be more cyclical in nature. But right now, when he was putting the index together, he felt they would benefit from the idea that we were going to be locked in our homes. One of the stocks that, well, go on, Mark.
If you can hear me okay, I was just going to point out that Clorox is an example.
Yeah.
Procter & Gamble.
So I don't think there's any buys necessarily on this list, but I think that it certainly keeps us open to brand new ideas. And there's complete industries represented by companies on this list that I haven't spent very much time even thinking about, let alone wondering if I should have a company from that industry. So I think this is a way to keep our minds focused on what's coming up in technology and in the world of the COVID-19 virus, and not just what's already there, but what is coming up. So I really like the whole concept, the whole idea. Go on, Mark.
Yeah, one thing I was going to suggest, if you was here, what is special about Moderna that has driven it to the top of the list here, from your perspective, your opinion?
Well, Moderna has a novel vaccine, a novel approach. It uses RNA. So what it's doing is it's basically programming the body to produce the protein uniform that the SARS-CoV-2 virus wears. So I was joking with you a few days ago that it's almost like if it was a prequel to the movie Red Dawn. That prequel movie would show what happened in Britain in the 1940s, where they dressed British soldiers up in German uniforms, and they were able to show people, if you see somebody walking down the street with this paratrooper uniform or this Marine uniform, the 12 or 14 different uniforms that would indicate that Germany has invaded Britain, realize they're not one of ours, they're one of theirs. The person obviously wearing the uniform wasn't dangerous, and that's almost like your own cells expressing this protein. They're not dangerous, they're just wearing the uniform the virus would wear. And it triggers a response from the immune system and trains it that if it sees these in real life, then it should go after them. So this virus has the advantage, this approach to tackling the virus has the advantage that the technology has been tested in the past and it works, and it can be developed really quickly and produced really quickly. And when I use the word really, I do need to put a caveat in there. It's really compared to the traditional ways of developing a vaccine. Just to put it into some context, they did come up with a vaccine for the Spanish flu 100 years ago. That illness erupted in big time in 1918, but probably 1916. They had a vaccine rapidly produced by 1942. And by the way, that's not unusual. Even today, it can take 10 years to get a good vaccine out with current technology. But Moderna has an approach that, and so does, by the way, the University of Oxford's approach, as a way of developing a vaccine that, if it works, could get out there significantly faster.
Very cool. Well, thanks, Ken, and Hugh.
Well,
what I thought I would share.
Mark, I have another stat, Mark, that I don't know, Hugh, if you've also heard, but I know that it's been thrown around an awful lot that the fastest vaccine on record that worked took almost 4 years to develop. So 4 is the fastest on record at the moment.
Right.
Which really begs the question that the audience asked going into the session about, what is pushing the stock market, and if it is 18 to 24 months, we're looking to see some of this stuff happen at light speed. All right, well, moving along here, the entire list of 100 companies are available as a dashboard, a public dashboard at Manifest with the COVID-19 extension. And you can see there's a couple that have still managed to be up there. Speaking of vaccines and healthcare-related companies, AbbVie up there at the top. Size selection of VMware, Amazon is still up there also, but you see a lot of companies there with some pretty frisky PEs. And that is a subject we want to cover today. But even more exciting for me are the 12 companies of the 100 that we don't cover yet, and I will fix that. So again, the list of 100 are there, and you're going to find your Domino's Pizzas, your General Mills, Pepsi. There are companies like that among the 100. I see that Adobe made this list. So yeah, it's quite a list. And look at Regeneron, one of our roundtable stocks, in the running here for among the more attractive, even after this huge run up by these COVID stocks from Jim Cramer.
And Mark, while I only owned 3 of the ones from the prior list, which a lot of those came from nowhere to be real, big performers. When I look at a list like this, which is made up of more of stocks that we have heard of before, and I go down, I own 9 of these stocks in various portfolios that I'm managing. So I think that we can still find good ideas. We just have to be willing to focus a little bit and take a look at it. We've brought a number of these to the roundtable. Even Centene, I know, has actually appeared up at the roundtable, as has Google and AbbVie. So we're not looking way out there in left field all the time, and Cramer's Index isn't doing that either.
Okay, any other closing comments? You know what Fastly does? Ticker symbol FLY
I have
at the top of the
no
list.
idea, but it's going on my list, Mark. Okay.
Well, I'm sure Kim will be all over it before we're done here. So it's obviously a rapidly growing company in an interesting area, but wow, some good stuff. All right, so again, looking from top to bottom on those PE lists, there's some of those on there that if they don't give you heartburn, some of you are on the floor shivering and needing resuscitation, 40s, 50s, 60s. And part of the message that we're going to have here for a while is for a part of your portfolio. And I hope you caught that. For a component or a part of your portfolio, perhaps the non-core part of your portfolio, the more speculative, but the more exciting, the place where some of our best small companies reside. Sometimes you got to be willing to chomp down on a company with a higher PE ratio, and we'll be covering this in greater detail, or recognize when the PE ratio really isn't something you shouldn't be paying attention to for an early stage company in the first place. let's go back.
Mark, we have an audience that's really on top of some of this, and two people out there, Kay and Sandy, are both telling me that Teladoc is in the process of acquiring Livongo Health. So one of those is going to go away and be purchased by another one on that fast-growing list right there.
Oh, there's always a bigger fish.
Ah.
All right. Let's go ahead and switch gears and just remind ourselves about PE ratios, because we're going to be talking about nosebleed PE ratios in some cases. And I just want to take everybody back to about 20 years ago when we actively wondered, while we were doing our traditional stock studies, how long could Paychex have a PE which was so much higher than we were comfortable with. And you can see that it ran around in the 40s and 50s for quite an extended period. And we would do our studies, and people would say, how long can that continue? And we weren't seeing any signs of weakness. And anybody who was brave enough in an investment club meeting to say, this could actually go down to 25, everybody, and everybody would giggle but yeah, well, look what eventually happened to the PE at Paychex, which is now in what is still a very robust. It's earned. I mean, this is a fantastic company, but high 20s when it comes to a PE ratio, and not high 40s, but high 20s, and it has an obvious effect on what goes on. Here's a longer term look at the stock price on the top, and you can just see it kind of has done that landing. Almost like one of Hughes' aircraft coming in and landing, and somewhere in that mid-20s area, it seems to be getting very comfortable over the long term. But again, a company that's cooking away with PEs that are elevated. And again, this was an established company with many, many years of operating history back in 2000, 2001. So it was, approaching some level of maturity. So the question we asked last week, because somebody else brought it up, was, are we seeing this again? Is this, another Paychex moment with Adobe? And my instinct would be, look at the long-term PE ratio on the bottom half of that big charts report, and it has been at, in that 50 range for quite some time. It's actually pretending like it could stay at 50 forever. And against our better judgment, I think we would, any study would probably not use an average PE ratio of 50 for Adobe, maybe something a little bit lower. Any thoughts on that, Ken, or warnings or reinforcements?
No, I agree, though, that right now Adobe seems like it's a really rich kind of a stock, and it's one that I've always wanted to own and just never been able to grab at. My clubs can't get by that PE ratio that you were talking about, and yet my Wolves Club, which is the longest operating club that I belong to, we've been in existence over 30 years now. Paychex was the third stock we ever bought, and we still own it. So at various times during our history, we've been able to swallow high PEs. But right now, we've taken a gander at some of the Adobe PEs and decided that they're too rich for our blood. Maybe they'll move down to more reasonable places, and we'll be able to pull the lever on them. I don't know. But we really, really do like this stock. But we can't even get the guts up to put it on our pounce list right now.
Yeah, and again, as a reminder, it matters where the company is in its life cycle, how fast it's growing, what its competitive environment looks like. Is it a Starbucks running out of places to put up another restaurant? All type of questions come to bear when you're thinking about being prudent with a PE in the future. All right, so I want to talk about something that kind of released the flying monkeys a little bit here. This is actually from Kramer talking about Tesla fairly recently, and he talked about Tesla being spectacular. It's an old Seinfeld snippet from the past, and the long story short, Tesla a year ago was $200, and it's now $1,400 for the stock price. And I was talking about this with Hugh the other day, and I was stunned to discover that they're doing so much in not so much automotive related areas. Would you like to expand on that a little bit, Hugh?
Yeah, I only started to become aware of this in the last month or two. A neighbor was talking about a solar roof, right? I'd always thought solar panels because I'm in Southern California. It often makes sense to have solar panels installed in your house. This house looks like it has solar panels on it, but the company bought Solar City. No, went quiet for about 2 years. It continued to sell solar panels. And then recently it has come out again with its third generation of solar technology. And it's a solar roof. They put tiles on your roof that look no different from a regular tile. There are 4 different styles, but recently they've only been focused on one just to get the manufacturing right. And they've come up with, it says here $1.49 per watt, or maybe it's a kilowatt, I don't recall, but in the second quarter call, Elon Musk said it's now under $1. And some analysts have looked at that and kind of agree with him. But they've got the cost way down. He has revolutionized the industry. How it's done, how they're installed. They're going to license regular roofing people to train them and license them to install these themselves. And now if you're replacing a roof, unless you're going to cover it in tar, it's a no-brainer to put a solar roof on there because it's actually cheaper based on both the tax incentive you get from the government and the savings you'll get in electrical generation. And if you couple it with what's called a power wall, which are those 2 little white boxes, just slightly over to the right, you can see them touching the grass. These things can store the energy, and then they can deliver it to the house at the appropriate time. And what that means is sun shining on your roof. It shines most during the afternoon, you generate most power, and that also happens to be the time when power is most expensive here in Southern California. So it's set up with a smart device governed by your smartphone, and it will sell energy back to the power grid when it's most expensive, and it will charge the wall when it's cheapest. There's only one thing that the energy companies have to do when they inspect this, and that's to make sure you're not buying the energy from them at night when it's, let's say, 10 cents or $1, whatever that number is, and then selling it back to them when they're selling it, trying to sell it to you for $4, and you can actually generate a little business out of it. They don't want that. So it is set up so you can't sell energy that you've drawn from the grid into your battery. You can't sell that back. You can sell energy that you generate directly from the solar panel. But it is a huge game changer. And they seem to have got the manufacturing right.
The thing that I found,
they seem to have got the distribution there. And at least in California, there is a mandate starting in a year or two where all new housing must have solar or its equivalent, generating X percent, I don't know what that figure is, on the roof.
the thing that kind of fascinates me about it all, even before you get to the higher level economics, is the fact that these shingles that they provide, they look exactly like shingles, and they're more durable. Mr. Musk would like to guarantee them for a long time. They're rugged, and then with the adobe roofs with the tile, they have these tile roofs. It looks exactly the same, and I think that's as you said, that's a game changer when it comes to this kind of stuff, because we human animals get kind of stuck in a rut when it comes to this kind of stuff. I mean, I could never stand the thought of solar panels on my roof when there were those big, thick, water-cooled, ugly monstrosities. But when we start doing stuff like this, and he was talking before we got on the call about wait until they do it with paneling on the house.
Solar wall.
Apply this effect. Yeah.
That has to come next.
So that,
Mark, I'm going to unmute Nick. He has a comment, and let's hear what he has to say. Okay, this is Nick.
Hey, Nick.
Yes. Hi. Can everybody hear me?
Yes.
Okay, good. This is fascinating because on the East Coast, we've seen some advertisements for a competing model from Generic or Generac, which also makes a similar product. Last week, we had a major storm system that came up the East Coast, and it knocked out the power here for about 3 or 4 days. My mother has a generator up at her house, and it was purring along, but the battery went out. We had to actually have the electricians come up and replace the battery just because it was 4 years old and they run out. So I took the opportunity to ask the electrician who had come up to replace the battery about the Generac system. And he said, well, he wouldn't purchase one yet. They are obviously bringing this product out because of Tesla. So Tesla has spurred on this competition with Generac. But he said he would not buy a system yet because, quote, they're still ironing out the bugs. Now, I think he was just talking about the Generic system, not the Tesla system, but that was a direct quote from an electrician who, rewired our house and who's pretty big where we live. So I just kind of offer that as a comment.
Excellent. Yeah, it just
good comment.
the evolving area. Go ahead, you.
But I think it's not too far away, as the cost of manufacturing these things has been dropping quite dramatically. You're going to get to the point where the government will start to remove the incentives because they won't need them anymore. In fact, arguably in some parts of Southern California, they probably don't need them now, other than people getting over that hump that you feel you might be a beta tester. You know what I mean?
Well, the thing that brings to mind for me is if you have all these EV cars, electric vehicle cars, and you're going to have solar roof, you're going to have something that's going to have to store all this energy. And is there enough lithium for the batteries to store it? And I want to see if I can find a lithium stock.
Good point. Yeah.
It's all in Chile.
Good stuff. So again, I think the main thing that we are talking about here is this notion, because we're going to go into a discussion about Tesla here over the next couple of weeks, probably.
Mark?
Yeah, go ahead, Ken.
I thought maybe it was just an idea. Kim said lithium and Nick's hand went up again, but then it came right down. So maybe that was inadvertent. So I'm gonna pass on that. Nick, if you do have a comment about lithium, put your hand back up again and I'll unmute you. Go on, Mark.
Yeah, there's a couple of fairly clear plays, Albert Marley being one of them, but the thing I think we all want to think about, again, out of the box with the flying monkeys, or as we're going to see in a few minutes, the flying cows. Is Tesla a car company? I don't think so. The progress that they're making on the battery side, which is extremely critical to the stuff we're talking about, that's the type of company they are. And as Hugh likes to point out, don't forget they're trying to go to Mars. And he told me they're drilling a big hole out in the west coast. I hope they don't cause earthquakes out there. Big tunnel.
Yeah.
Boring. I'd not heard of this before. Hugh, go ahead and share that little nugget with the audience.
Well, they're keeping tight-lipped on this. It's not part of Tesla, but it's part of Elon Musk's portfolio of companies. It's called the Boring Company for obvious reasons. It's boring holes in the ground. And they want to create, they want to generate a tunnel between the LA Basin and Las Vegas. It's one of the most traveled routes in the country, and they will have cars hurtling through that tunnel at 200 or 300, 150 or so miles an hour. So, yeah, at least the rumors are that they're working on that. There are people just north of here in the higher desert that say, yeah, the Boring Company is digging away up here with the machine. They apparently have got the cost of this tunneling down to where it could be competitive, and certainly with airline travel, but the convenience is there as well. There's another company trying to build an electric rail line between Las Vegas and Los Angeles. So certainly entrepreneurs see something there. Infrastructure spending and investor capital don't seem to go together that well generally, but in this case, yeah, it is.
Yeah.
Hugh, are they talking about a completely electric rail, or are they talking about maglev?
It could be maglev they're talking about. I thought it was a regular electric train, but it has to be maglev, given the speeds that I've read they're talking about.
Frictionless. Yeah, and the other comment,
Not what they call hyperloop, not that.
the comment you made about them boring this tunnel because they might be practicing up to do the same thing on Mars. I mean, that's out of the box thinking, for sure.
Yeah,
So again,
certainly their new truck looks like it would fit in Mars quite well.
so we're
Mark, we're getting a number of comments about Kim and the lithium. Kim, there's some people in the audience that think that lithium is old school and that we've moved on in our battery technology to use other types of elements. I'm going to ask whether or not anybody wants to actually speak about that, since you've written about it. And if you want to speak about it, if you'd put your hand in the air. Okay.
and I think even if not today, it's a topic that's probably going to persist a little bit as we talk about the opportunity that is in the field of battery, next generation battery development, that sort of stuff.
Okay, I'm not getting hands in the air and everything, but I am getting a lot of confirmation, Mark, on the merger between Livongo and Teladoc. So
Okay.
that does appear. I'm getting citations and articles and everything. Folks, I don't need that much right now in the bathroom. Okay. Thank you, though. Thank you.
We have such a wonderful field of research analysts out there. I think we should form a company here, guys. Anyhow, again, framing where we're going to close today's discussion, and again, just nudging us towards perhaps a little out of the box thinking is the thing we've spent some time on. If you're not familiar with the subject of projected return on value, and not any value, just enterprise value, PROVE is what we've abbreviated. There's the math, basically the projected pre-tax income, the pink line on your stock selection guides, divided by the total enterprise value. Again, the stock price, the total liabilities, not just the long-term debt, the total liabilities with credit given for cash in the bank account or checkbook. And you can read those sound bites to the right. One of the reasons that we find it so attractive is we believe that this is going to allow us to discern earlier in the company's life cycle, because the pre-tax income goes positive and shows up on the graph faster than some of Hugh's companies with the disappearing earnings. When he brings us to us the first time when they don't have earnings on the chart, well, chances are they're going to have pre-tax income charted earlier than that. And in any event, earlier can be better, especially when you find a company that really has some promising ideas about the future. Here is a graph for context. We shared this with everybody a couple months ago. Just wanted to update it. It has not changed. This is the distribution of companies. These are the value line industrial. So it's about 1,300, maybe 1,400 companies. And you can see that they range from close to zero up to mid-20s when it comes to this metric, this projected return on value, which we believe will emulate or be similar to the projected return in section 5 of your stock selection guides. So again, a bell curve kind of peaking out in that 6, 7, or 8% range. Some of the more attractive companies are going to be in the low teens. Some of the very speculative ones are off to the right. But notice that there are actually very few companies down at 1% or less. Those would be the ones that we would consider to be a little bit frothier. As we noted last week, Ann Manning noted that there's quite a few companies with higher PARs. They seem to be coalescing and coming down. The projected returns, thanks to the PE ratios for the most part, are going to be more volatile, more dynamic. So this projected return on value is going to be a little steadier, and it's not going to range quite as much when it comes to the spectrum. So again, this is just to give you context. So when we're talking about a company in the field of companies that we're looking at, anything in that 10% and above range might be worth taking a little bit closer look at. As we talked about last week, we do expect over time that projected annual return on the left, which is currently at 8.1%, come to resemble or emulate the value line low total return forecast, which right now is around 6. It's actually 6.1 as of today. And the projected return on value for these 1,300 companies is at 6%. So it's already true that the value line low total return forecast is basically tracking with this PROVE. And we do expect that blue bar to continue to approach as the analysts are just moderating and conditioning their forecasts downward. It's a steady process and something that I watch every week. Why do we care so much about this? Because our experience has shown that the value line low total return forecast is the one most likely to come true over time. So it would be really nice to see these all kind of run together. So here's the question that we will end today, but this starts a discussion. Is Tesla a car company? Because that's the people who are thinking of it as a car company say things like there's never been a profitable car company, which also isn't true, but mostly true. So a traditional stock study using a PE, the PE right now is NMF when it comes to Tesla. They just had their 4th continuous or consecutive quarter of positive earnings, so they now are eligible to be listed in the Standard & Poor's index of stocks. But when you look at a value line low total return for Tesla, right now it's checking in at about minus 20%. And again, just a company, but if you look at it using the PROVE number, we're looking at a number in that 2 to 3% range. So again, this is a company that's gone from $200 to $1,400 in a year. People are foaming at the mouth saying it's way, way, way overpriced. They could be right, but there's also a school of thought that says that this is not just a car company, and that's kind of the way I'm leaning. And I would like to figure out, you know, especially for the next time we get a little bit better buying opportunity than where it's at. I really don't believe it's as overpriced as most people think it is. Any thoughts on that from any of the participants?
Mark, I want to, I don't have a thought on this, although I'd be interested in what par value you would expect. Are you assuming that the par value you would calculate would be close to the value line low total return?
Our current par value, because keep in mind it embeds a number of pretty optimistic analysts, is running at about 10. So it's running closer to the PROVE number.
Okay, I could you go back 2 slides to that, just that 3-bar graph that you had there, that one right there? I'm wondering, Mark, if I agree with you that at some point these values should move closer to each other. But I'm wondering, rather than that light blue one moving down to kind of match the green or the red, if we won't see the green and the red move up as the light blue moves down and have them meet somewhere in the middle. And the reason I say that is that I'm asking myself whether the analyst opinions for the next quarter, this year, next year, haven't begun to swing to, for a lot of companies, swing to pessimistic or very pessimistic, and that we won't see, as we move out of the recession that we're in and move towards recovery, that we won't see a little bit of strengthening of the value line low total return, and therefore I think that we'd also see some strengthening of PROVE if the companies are coming out and beating the income numbers that right now we're basing a lot of PROVE on. It seems that in earnings season right here, half or more of the companies have done a pretty decent job of beating their income number to the positive side.
Mm-hmm. Yeah, I'm with you, Ken. I do think that, keep in mind that the PROVE is a 5-year it's basically the 5-year estimated pre-tax income. So it's influenced by what is going on in 2020, 2021. Obviously influenced, but it's not the whole picture. You know, as far
Right. Well, and that's why I think we're only playing with 2.5 percentage points here too, between proof at 6 and par at about 8.5 right now. We're not playing with huge percentage points, and if we're dealing with averages, I would expect these to meet somewhere in the middle, down around that 7%, and that's certainly a number that we've heard of coming from a lot of different sources over the years, as far as growth with a certain size company that we can expect, you know.
I agree with you completely. If you start looking at historical rates of inflation and interest rates, which are basically now zero, and we've not seen this before. Yeah, there's a number. I don't know whether it's going to be, you know, coming up to meet or whatever. These are going to resemble each other at some point.
Well, let me take my thinking one step further. I understand how this might be helpful on early stage companies where they're just beginning to report pre-tax profit and they don't have true profit and everything. But might this also be a better tool for us to use on a company like Tesla or like Amazon that has earnings, but the earnings give it an extremely high PE value? And that's what focuses us in an SSG away from that company. I mean, you and I have laughed and chuckled over the PE value that Amazon assigns itself a lot of times by not being interested in turning any kind of a traditional profit. And I'm thinking that maybe this allows us another tool to look at companies with higher PEs, and I'm thinking, you know, 60 plus, 50 plus, 70 plus, somewhere in that area, and come up with a value that'll probably be a lot less than a typical par value if you were to use average PEs on your par value, which most of us would never choose to use on an SSG. But I'm just thinking that this proof might at least give us another number, as it does on Tesla here, to consider on your way to asking yourself, you know, do I get on the wagon and ride it somewhere, or do I still turn my nose up at it and say that it's way overvalued?
Yeah, I agree. I think that without belaboring the point too much, we're going to take Amazon, we're going to dissect it, look back at it over 10 to 15 years, and we'll put together a slide for next week for probably Amazon and or Tesla that basically looks at the two analysis summaries, and notice that, you know, this one down here doesn't even have PE in it. And again, it's that notion that we've talked about, one auditing the other. I think we're going to see that take shape. And in other words, when you get done with your stock study on Amazon and you have this projected return on value, which doesn't even look at PE, and you're trying to reconcile the two results, it gives you basically some input on what a reasonable PE value might be for a company like Amazon. So I think you're going to find it fascinating.
We're getting comments, Mark, that people would love to see both of the stocks analyzed in that fashion. And then we have a comment from Cynthia that says, don't forget in all this talk about Elon Musk and his companies that there's also SpaceX.
Exactly.
And it's just done some historic things as well within the last week or so.
Exactly. Perfect. All right. So
Yeah, it's stunning what he's doing with this company.
Go ahead, Hugh.
No, it's stunning what he's doing with his companies. I mean, just stunning.
All right, I'm showing we're at about an hour, so I'm going to go ahead and we'll stick around for a couple of minutes for questions and answers, but I did have to use the slide from Twister, because this is what I lived through here this morning. Here in northwestern Illinois, we've got an airborne tractor on the left, and we have the cow. And if you've seen the movie Twister with Helen Hunt, they're actually driving down this road and they say, "We got cow," and the cow is airborne. And from that movie, I'm told that no animals were harmed in the making of that picture, but I just wanted to point out that's no bull for purposes of our bull session. So we will
How you making this?
Okay, Dorothy, time to click your heels and go home. All right.
All right. We're going to go ahead and shut down. No bull. We're going to go ahead and shut down the forecast or the broadcast or the recording. We'll stick around for a few minutes if there are questions, but we do commit to taking a closer look at companies like Amazon and Tesla, especially since Amazon has more operating history that we can learn from. But these are evolutionary that we want to try to understand better. We'll try to do that. And, see if we can't figure out why Hugh McManus was right 6 years ago when he was lonely in a room full of people in Chicago, Illinois. All right, with that, again, that's no bull there, people, and we'll see you next week.